people have really shut their wallets. They've gone, you know what, I'm not going to buy as many goods and services as I previously have been. You know, we're starting to see already pretty clear evidence that the economy is weakening.
Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 25th of May 2026. I'm Head of Research Nick Goodall, and today I'm joined as per usual by Chief Economist Kelvin Davidson. Kelvin, we'll preview the monetary policy statement and official cash rate decision very shortly. But first, I thought we could just quickly cover off the release of our monthly chart pack, which went out last week. You led that mostly with the review of sales volumes figures, which obviously are pretty weak so far this year. Do you want to go over those headlines and just anything else from the report that you thought was of interest this month? And if you have anything else stuck out for those journalists and the conversations that you had following the release of that?
Yeah, I mean, I would talk about buy classification every month because it's, you know, it's my favorite data, but it might get a bit repetitive. And actually the story at the moment is pretty repetitive too, with first time buyers staying very strong. So had to look for a slightly different angle. And we do change the angle each month. I'm being a bit facetious there. But yeah, this time sales, I mean, I think that's probably been the biggest theme in my mind for the past couple of weeks. You know, we're already pointing out that sales over January, February, March had been down each month compared to the same month last year. We got April's numbers; they were down as well. So you know, 4 months in a row of falling sales compared to the same time last year. Now the falls haven't been huge; like it's not the bottom of the market isn't falling out, but yeah, activity has just had a slow start to the year, and you know, January, February predated the Iran conflict anyway. Then you add in some lags, and you know, you could say even March sales figures probably not really affected by Iran, maybe even April to some extent too. So, you know, this is a pretty soft start to the year, even before you take into account the Iran conflict and knock-on impacts for interest rates and the economy itself, and jobs and consumer confidence and all of that. So yeah, it seems like that is a pretty big theme. So we had, I mean, just to illustrate the numbers, as I said, we've had falls across January, February, March, April. Adds up to about 5% down in total over that first 4 months of the year compared back to this time last year. About 1,500 sales in numerical terms. So yeah, the falls, it's, as I say, it's not collapsing, but it is quite a bit weaker than what we were perhaps anticipating, which was potentially growth based on how things looked at the end of last year. So, yeah, quite a big gap, I guess, opening up between where we thought we might be and where we actually are. And of course, that means listings on the market have stayed pretty high. You know, it's still a buyer's market, and for those people who are confident about their job and ability to withstand higher interest rates, it's, you know, it's a great market to be in. There's still plenty of choice. You know, those new listings are still coming forward. Not many properties being sold, so there's a lot of choice there. So yeah, I think that is the story at the moment. And of course, we're seeing that. I mean, house prices have edged up ever so slightly, but you know they're certainly not booming. So it's just a pretty cautious market out there, and that's before the impacts of Iran have fully come through. So I think that probably is the story at the moment. I mean, just to talk about the outlook we did have and compared to perhaps where we are now, go back to the tail end of last year, we were looking at perhaps mortgage rates, or I guess a lagged impact of those previous interest rate falls still coming through, you know, hopefully a strengthening economy, bit of an upturn in migration. We were looking at maybe sort of 10% growth in house sales this year, going from about 90,000 to 100,000 in broad terms. Now, based on kind of a bit of gut feel, a few rough numbers so far, changing that model around. We'll formalise that over the next sort of week or so. But just sort of back of the envelope numbers now, based on what we've seen for higher mortgage rates, probably a weakening economy. Okay, migration is turning around, but wage growth might stay pretty low potentially, unless we get that second round inflation effect coming through. Those things have definitely all got worse. So it could be that actually, based on early indications, you know, the market does well to stay at 90,000 sales this year. So hold pretty steady from where we were last year, rather than getting to 100. Staying at 90 is probably not a bad outcome. So that's kind of, as I say, we'll formalise that, but that's kind of the scale we're looking at, and it's been. And not least because we've already had 4 months of falls. You know, you're starting from a lower base, so to get to 100 just gets harder and harder. So, yeah, that's kind of the scale of change. Now, a sales total of 90,000 this year wouldn't be horrendous. I mean, that's about the average, but compared to where we were thinking of continued growth, it is quite a bit weaker. So that's kind of where we sit. It's definitely still a buyer's market, but I guess those buyers have to have confidence about their job and their income, or else they're going to be cautious as well. So it is, and more to play for, or more to come through in terms of Iran as well. So it's soft start to the year.
Yeah, I think that's all just really interesting, right? And I suppose I just wanted to add some context here because if you think back to, earlier in the year, even when we came back in February and we were talking about January was pretty low, but it looked like December was really strong, and that might have brought some sales volumes forward. So we did think that the year, while it started off a bit weak, we were like, oh yeah, but that's actually a reflection of December finishing strong. December did see like quite an uplift in transactions and lending, and partly, and I still think this is true, that would have reflected the fact that, in November we heard from the Reserve Bank, the OCR had hit its trough. No, didn't expect any more falls to the official cash rate. Interest rates started to lift, and so there was this incentive that if you were coming into Christmas and you were like, I'm going to buy a property or looking at buying a property within the next couple of months, there's a pretty decent incentive to get that done sooner rather than later. And it looked like some of that volumes that could have happened in January, maybe February, got brought forward to December. So we started that year saying, yep, these numbers look a little bit low for the start of the year, but December was really strong. So it was just, some of that activity being brought forward. It wasn't sort of until we got March and April and it continued on, and then you get the disruption and you go, yeah, well, it does look like this is actually perpetuated on a little bit more. And yeah, I just wanted to reiterate the point about that context of where it's coming from, right? Like we'd seen growth the last 3 years, a trough of 65,000 sales in 2022, growing, gradually, I suppose, in the intervening years, getting to a point last year, 91,000 sales, still not quite at average, it's probably just a little bit below average. And that average over the last couple of decades, we call it a flat line. It probably should be an increasing line, right? We should see transaction volumes slowly increasing year on year because we've got more properties, more population. So you should see if the turnover rate stayed consistent, the number of sales would actually increase. So you should see that line increasing, and it's still not exactly storming off. And yeah, we were projecting it to get to that average of 95 to 100,000. Now it's looking very unlikely for that. As you say, all the inputs to that sales volume forecast model are generally from the Reserve Bank when they publish their monetary policy statement. So, whether it is GDP, migration, interest rates, those things are all out this week. Inflation, we'll update it following the monetary policy statement this week. So I think it'll be a good one maybe we'll just briefly update it next week in terms of the actual number that model spits out. Don't need to redo all of the conversation we're having today, but a worthwhile one to talk about next week. But yep, I totally agree with your point that it's going to come back to that 90 to 93,000 probably. And that's still going to be very, dependable on how long this conflict goes for, right? If we did see it end tomorrow, and again, you could say yesterday's headline was that a ceasefire looks genuinely real, but I haven't caught up on things today, so it could well have changed again. If it does end sooner, then maybe that confidence comes back sooner. We see some growth in the economy in the second half of the year, like who really knows? And that sees some lift in transaction volumes, again, dependent on maybe what's happening with the election. Does the election slow things down? If there's uncertainty and potential switching of government, again, people might be incentivized just to hold off any transactions and wait until they get that certainty following the November election. So, there's still plenty of uncertainties here for any projection we're going to put out there of how many transactions we expect. But, I do think it's, number one, it's going to be dependent on how long this disruption goes on for, and what this truly looks like between what's happening in Iran with everything over there. So yeah, I think that's, I just want to reiterate those points anyway. I suppose the other thing was that, is to point out there's some regional differences here. When we look at our year on year chart that we present, it's the last 3 months compared to the same 3 months the year before. Tauranga, Wellington, sort of looking the worst on those ones. Tauranga has actually been sort of slowly dropping away in terms of sales transactions for, probably 9 months now, if not a little bit longer. Wellington, we've talked plenty about the weakness here. Obviously, we got that announcement last week of some more job cuts to come over the next 3 or 4 years from the current government. So again, that's just bringing more uncertainty to the job sector, to the economy here. And so I think, that's going to play out with fewer people being willing and able to go out there and buy property. And so those transaction volumes taking more of a hit, given Wellington's susceptibility to a weaker economy, I think makes sense as well. But it is really has turned sort of, south for all of the main centres. It's not as great in some areas, but yeah, it's, there's definitely some regional variance there. And I suppose, the other part of this, of course, is what influence of supply from a listings perspective. And again, the monthly chart pack did have that that chart showing, the change year on year for each of the regions. And I suppose the main thing I noted was that Southland is still, there's quite a significant decrease in available listings for Southland. And so again, that sort of lines up with the conversation when we talk about even if demand's reduced a little bit, if supply's down, then those buyers don't quite have the same power, maybe a little bit more desperate because their choice is lower. And so there's actually some upward pressure on prices, and that plays out when you look at the home value index as well. So yeah, it's probably just to round that out with that conversation around, this is, we can measure demand by all these things, and that's going to see transactions occur. What's happening on the supply side of things is really important too, and there's definitely that worthwhile looking at that regional chart for people to understand what's happening in their area, and how that might play out when it comes to that balance between listings and demand, and where that goes with sales, with values as well, which again is detailed in the pack, but stuff that we talk about at the start of the month anyway, so we don't often talk about it once it's published for the second time in the monthly chart pack. But yeah, I think that pretty much covers off all the notes that I had on the chart pack, particularly when it comes to volumes, Kelvin. Anything else that sparked in your mind, or should we move on to, I guess, what would be an MPS and OCR preview?
Yeah, no, I think interest rates. So it's what everyone's looking forward to, or well, looking ahead to at least. They might not be looking forward to it if rates are going to go up. But that's the big thing this week.
Well, looking forward to, I suppose some sort of certainty, right? It's we're going to get a lot more detail and clarity from the Reserve Bank. And as I often say in presentations, right, like we don't put out there what we think the Reserve Bank should do with the OCR. What we try and do is go, given all of our experience and reviewing all of their communications and their decisions in the past, this is what we think they will do. And that's where we reference all their terminology, path of least regrets, and all these things. So, that's our job, I think, and that's where I think we are looking forward to it, because this week there's no doubt we get some clarity on their thinking of things. We get their updated forecast on their projections for inflation, OCR, economy, all these things, right? House prices. So yeah, very much looking forward to the release. I suppose in terms of, the way we can structure this preview, there was a couple of those monthly data releases, particularly for April, that came out last week. So it's probably worth just a quick review of those, maybe talking about how the Reserve Bank might consume those and read those things. Yes, it's late data, but it'll still give them a decent feel for, what are their main concerns, right? It is that second round inflation, like you spoke about. It is going to be how strong is this economy looking, or weak, probably more relevant. But yeah, so I don't know if you want to, just run through those things. I'd say as a high level, probably pretty weak, with the performance of the services index for April and retail spend data for April as well. So you want to run us through just those key stats from those releases, and then you can flow into, I suppose, how you expect the Reserve Bank to read it, what their decision will be, and even if you're feeling really game, then how they might see that as influencing a July decision, which we know is the one that's probably most up for grabs right now. But yeah, over to you, mate. Away you go.
Yeah. So I mean, the economic data last week very much consumer focused, sort of household focused, and I mean, there's no surprises. It was pretty weak. Yeah, whether it changes Reserve Bank expectations, or they're thinking too much, I'm not sure. But I mean, that we had the BNZ Business NZ BNZ Performance of Services Index for April. That was unsurprisingly below that 50 rise fall mark. It's been a pretty weak run of results for the services sector, and no surprises, households have been under pressure. Tourism, I mean, it's recovering now, but maybe that tourism sector hasn't been as strong. So the services industry has been pretty soft.
What
so not helpful.
So can you give us the I don't know, easy to understand version of what are the core services that would make up that? Like you said, tourism. What else would be the core things?
Yeah, so I mean, I really take that to be things like hospitality, restaurants, sort of that sort of food spending type of stuff, accommodation. I believe, I need to check that, but I believe you have other services like financial services, insurance, that sort of thing in there as well. So it's not just sort of household spending, but I guess the thing that most people would relate to would be, going down to your local restaurant, having the tourists come in and staying in your local hotel or motel, whatever it is, Airbnb, whatever. So that sort of activity has been under a little bit of pressure with, I mean, interest rates have obviously been coming down lately, but households still a little bit bit uncertain. So yeah, that's the kind of services sector, and it's been on a weak run of results for really 2 or 3 years. I think probably the bigger thing that caught my attention last week, though, rather than that index, was just retail spending from Stats New Zealand, or it's electronic card spending, they call it. So it's a monthly indicator. They have a benchmark kind of retail sector indicator every quarter, but this is the monthly electronic card spending. And yeah, she was pretty weak for April. It was down 1.3% in total. Now this is not adjusted for price changes, so this is simply the dollar value of spending. So it was still down 1.3% month on month, even though prices would have generally drifted up in that month. So certainly for some items within that basket. So the volume of spending was likely down even more, or the real amount of goods people were getting or services. So pretty weak number. Fuel spending was actually down 2%, so even worse than the overall number, and that again, not adjusting for those price changes. So it looks like in here there has been basically a change of behaviour. People have really shut their wallets. They've gone, you know what, I'm not going to buy as many goods and services as I previously have been. So pretty weak set of numbers, and so that might kind of feed into what the Reserve Bank's thinking. We're starting to see already pretty clear evidence that the economy is weakening. There's already spare capacity. That weaker activity will tend to bring down inflation anyway. And this is the Jared Kerr point from Kiwi Bank. So yeah, I think we're definitely seeing evidence of that. I mean, I still just come back to the Reserve Bank having one target, it's inflation. That's the thing. And there's a credibility argument in here, and I guess a sort of perception argument that the longer inflation's above target, the more people get concerned about that. The Reserve Bank does run the risk of losing control a little bit, or losing people's belief that they can control it. So I still sort of come back to that, but definitely acknowledge the economy is weakening, and there's no surprises there. That higher fuel prices are a tax on households. Effectively, it's going offshore, and so there will be spending changes made. People will pull back and spend on different items, and maybe scale back to those necessities rather than those nice to have. So yeah, definitely aware of all those arguments, but I still just come back to inflation being the thing. And so I expect there'll be some strong discussion coming out of the monetary policy statement on Wednesday around inflation, and they're definitely still vigilant to all these second round effects. I suppose the thing I'll be the number one target for me, the number one thing in all of this stuff that's going to come out on Wednesday, is simply going to their spreadsheet, looking at what their forecast is for the CPI. And so if that has, I mean, it will change, but I guess the question is how quickly they see that impact coming through, and I guess where the peak for inflation gets to and how long it's lasting, because I think from that we'll be able to infer quite a bit about what they're thinking, and genuinely how concerned they are about those second round price effects. So yeah, that's where I'll be going first. I mean, the actual decision itself on Wednesday, very unlikely to be a change. It's going to be more about sort of the commentary and the spreadsheets and everything. July versus September, yeah, I still probably sit on the fence on that one. I got to say, you can see all of this. You can see these inflation pressures, but you can also see the economy weakening. And I mean, if I had to opt for one or the other, I'd probably go September. But yeah, it still just feels a long way away as well, particularly for people who are getting more and more concerned about prices. That's probably compounding every day, and September still feels a long way away. So yeah, probably haven't said too much there that gives people any clarity, but I just fully aware of those economic risks, and I think it's becoming clearer that's coming through.
Yeah, I think for me, like that to me is a pretty clear sign that destruction of demand, which seems to be the term of the moment, is pretty strong, right? The fact that we're actually paying less or spending less on petrol right now, despite the increase in prices, shows we've adjusted behaviour. Because we're paying so much for that and everything else attached to it, we're now buying less of it. And not only that, our activity elsewhere is also reducing. And so that to me shows that quite clearly we are being impacted by this. We're reducing our spending, and it is going to put some downward pressure on inflation of domestic goods and services, right? So that to me is pretty clear that, yeah, the official cash rate doesn't need to lift as soon as otherwise. Now, again, I think to me, this data surely reduces any small chance we had that the official cash rate could lift this week. Now, I've learned my lesson, and I'm not going to be betting on the result this week, but I really don't think we're going to see an increase to the official cash rate. I'm pretty confident of that. I think it does pose further doubt on that increase in July, and I definitely am firmly pushing more towards the Kiwi Bank team's state of thinking here. But I think it does cast that doubt. Probably worthwhile. I need to have a think about this and have a look at it. What data are we going to get between now and that July decision? What other information will they have that could lead them to get a feel for those things, like you said, medium-term impact of inflation. How much can we get a feel for between now and then? What sort of info can we have on second-round impacts of inflation? I'm really interested not only in their forecast of CPI inflation this week, but it will be because I think they forecast both the tradable and non-tradable inflation, right? And that's the thing for me. Like, you can't do anything about this tradable inflation, the stuff we're paying for overseas, these gas prices, petrol, oil prices. Like, the OCR does not control those. I get that you're going to try and drag down the headline inflation level by influencing the domestic inflation, the non-tradable one, which means that the midpoint or the headline figure will come down, even if we're paying 4.5%, or 6% more, or whatever it is on the tradable inflation data. It won't be that high, sorry, because I think that tradable inflation actually was lower than the other one before. But either way, you can't impact the tradable one, impact non-tradable, keep that low, and that will drag down the headline figure, which is the one figure, like you say, that they are being measured on. So I don't know. I am certainly swinging more towards that. July goes from what we'd call live and 50-50 to I think it's a 40%, 60% chance of a lift in the OCR. So 40% chance of a lift based on this data. Again, there's no doubt that's going to change off the back of Wednesday, their read, their commentary on it, off the back of whatever next data's out between now and then, and again, whatever other data releases we get between now and then. But I'm feeling a stronger feeling towards the fact that this is showing that, we're clearly seeing our economy get hit from that. That is going to have a downward pressure on the inflation. So it's not just a weak economy and the Reserve Bank are going to go, we don't want to ruin the economy. It's like, yeah, but that actually reduces what that medium-term inflation looks like. And totally agree. The forecast, this is going to be a spike in there. It's going to go up. There's no doubt about it. And, I feel for them because they're in such a tough spot because that inflation rate forecast is going to look different depending on how long this disruption goes for. If it does end in the next week, then that forecast would look very different than if it goes for another 3 months. How do they get that across in their commentary? Do they have to have multiple forecasts? I don't know what they'll do about it, but everything has to be taken with a grain of salt because it is so dependent on one pretty big thing in the world, which is a genuine ceasefire in Iran. So yeah, look, it's not an enviable position for the Reserve Bank to be in. I'm glad to be an observer of it, not a decision maker within it, but also we're going to get some pretty good clarity too, I'd say. Like, I think the detail is that if it goes to vote, so if it's not a consensus of what to do with the official cash rate from the committee, then they will publish the vote of who voted which way, along with commentary as to the justification for each of the committee members as to why they wanted to do what they voted for. So that'll be pretty cool. And first time we see that level of detail, as long as it does go to a vote. So, if it is a consensus, then we won't see that. Man, I'm almost talking myself in. Why don't we see an OCR cut this week? No, I'm joking. Don't take that seriously. That's tongue in cheek. We're not going to see a cut. Maybe one person will vote for that. No, they're not. So very interesting one. The transparency, the read we get on this is going to be huge. Not just the data itself, but potentially from that conversation and some of the genuine, reasoning from each of the different committee members too. So look, she'll be an interesting Wednesday. For those wondering, yes, we will podcast not long after the decision. So it'll be a pretty quick scan and look through the data. And as you said, go to those spreadsheets, and then we'll record in the afternoon, not long after, and get that one hopefully published sort of by 3 or 4 o'clock on Wednesday afternoon. So keep an eye out for that one. It is a good reminder to make sure you've got, the alarm bell little thing set on your podcast player and auto download there. So it goes straight into your podcast player, so you know exactly when it's turned up, and you'll get our pretty quick take on that one, because I think we're definitely going to record sort of before 3 o'clock. So make sure you got that one sorted. But yeah, mate, that's where I'm leaning. I'm slipping off that fence and going one way, not the other. That's for sure. But I still reserve the right to change that depending on the data. So yeah, gonna keep pulling back to that one too.
Yep, fair enough. Economists say when the facts change, I change my mind. So yep, nice one. But yeah, I think when I said my number one thing, we're looking at that CPI forecast. Actually, it's first equal because we're looking at the OCR forecast as well. Because of course they publish a forecast track for the OCR itself. And in fact, you might be able to see that before you even get to the spreadsheet, because probably their sort of overarching PDF, I guess, at the very front will have a comparison chart. That at least they've been doing that in the past of old OCR forecast, new OCR forecast. They set it out pretty clearly on a chart. Now it's not a forecast, I guess. Should just be careful about that. It's sort of their central scenario for where it might go. They're not necessarily saying it will go there, just if everything turns out as they currently expect. That's sort of an indication. But yeah, there's two things: CPI track, OCR track. Those will be the two biggies, and probably, if anything, the OCR track's the bigger one because and it won't be. It'll be the change, how it looks different compared to what they said last time. So yeah, we'll know a lot more in 48 hours ish.
Yep. No, looking forward to it. And yeah, I just wonder if they will change the way they talk about it, if they do have some scenarios. But yeah, we'll wait and see. All good, mate. Well, that is it's sort of for that data log. The other thing on my mind, of course, is that we do have the government releasing their updated budget this week as well. Now, I mean, we kind of get asked about this all the time. I've once been in the budget lockout. To be honest, it was pretty boring, particularly when we focus so much on housing. Yes, it's all tied to the economy and that is dependent on their spending and stuff. So there's always going to be a bit of detail in there. But I think, and as always, they do sort of, hint, they drop sort of pretty clear ideas about which way they're leaning. And there's no doubt that this government has said pretty clearly that they've reiterated they'll be fiscally restrained and responsible this time around again, or continue to be that way. So I don't expect we're going to see any mass uplift in spending or investment anywhere. So I don't think there's going to be too much for us to necessarily take from that. It'll be interesting to see. Yeah, I'm not sure that the finance minister will get asked about the Reserve Bank's release as well. So it'll certainly be an interesting time through that day and a half from Wednesday afternoon through to Thursday as to the commentary and people's different takes on this and what's going on in economy, housing market, expectations for the year. It's going to be really interesting. So yeah, I'm not sure if you've got any thoughts on that. The other thing I was thinking was, do they have any more say on social housing, investment in Kāinga order? We know generally they've kind of taken some of the investment from Kāinga order to those chips. Do we see any modification or reaffirmation of that? I don't know. But certainly the social housing side will be maybe one thing we could take from the budget. But yeah, otherwise I'm not really expecting to see too much that'll be of interest to us or our customers, clients, listeners, whatever it is. But yeah, anything on your mind when it comes to the government budget, Kelvin?
No, not a huge amount. I mean, there's been nothing said about. I mean, in the past, I don't know if they did it at the budget or not, actually. But big changes like the ring fencing of tax losses, interest deductibility, these things. Nothing on that scale. And there may be details. It'll be a job for Copilot or Gemini or whatever to sort of scan through the forecast tables and things. Sometimes there can be little policy tinkerings that are hard to sometimes pick up in the sort of commentary or written part of the budget. But yeah, not expecting too much in terms of direct impact on property either way. I think it'll probably get a little bit lost maybe in terms of the OCR's decision or the Reserve Bank's decision, I should say, on Wednesday. But yeah, not expecting a huge amount. I think it'll be jump in there, scan the old AI over it, see what it says, and yeah, kind of move on probably. But we'll see. Could be wrong.
Yep.
Yep.
Yeah, I mean that's obviously an important one. So you never quite know what could be in there. And yeah, given it's an election year as well, they'll certainly be mindful that everyone's going to be very interested in where they are choosing to spend their money and how things might change in the future. So yeah, we'll pay attention. We'll talk about it next week, no doubt, if there is anything to talk about. But otherwise, that's pretty much it for property and economic news, mate. We'll look forward to Wednesday anyway. So just leaves, catch up about the weekend, mate. Anything you get up to over the weekend? What sport did you catch? I managed to get along to the Canes on Saturday night and I've locked in first position. So happy to do a bit of a Super Rugby chat shortly. But yeah, what's on your mind?
Yeah, not a huge amount. It was pretty standard weekend. I played golf for the first time, I think, in about 8 or 9 weeks, which was actually better than I thought. Maybe it's a case of practice doesn't make perfect. Sometimes I actually did better without practice, but so no, that was good. And yeah, just generally family stuff apart from that. So not too much to report. A very very standard weekend, and yep, following sport here and there when I can, and yeah, back at the desk now. So no, going good. Yourself?
Yeah. I mean, from the Super Rugby perspective, I don't think we've got the time or the listeners have the inclination to listen to me go through the permutations of the Canes and Crusaders and definite potential positions based on the last weekend of round robin games this weekend. But needless to say, there's a few random things that could go on. Hurricanes don't need to win. Chiefs don't need to win. A bit of a random one when you get to this stage of the season, and there's no incentive for these teams to actually win a game. But I suppose they can affect the opposition they're playing, and so do they care about that? But certainly an interesting one. Canes are travelling down to the Crusaders this weekend, so I think those games are never going to be easy ones for either team. So we'll be interesting to see how that one plays out. Whether the Canes do rest a few players, certainly those losing niggles, I'm sure they will. It almost reminds me of the local Masters divisions, top Masters divisions in Wellington, cap football. It does feel like it's turning into a bit of a farce as teams appear to be trying to not finish in the top four in their pool for fear of finishing and then going into the tougher draw for the second half, having to face off against these really, really good teams. We managed to win 6-4, but I'm, without trying to throw dispersions out there, the opposition, I don't think were trying too hard. They did not want to finish fourth, and so we're now at real risk of finishing fourth, which I wouldn't say we're stoked about, but I cannot go into a game not trying. And that was certainly the case on Saturday. So it's a bit of an interesting one, and as I said, almost a little bit of a parallel there to Super Rugby, although a little bit less serious, I suppose you'd call it. Not that the guys think that one, they're onto that field. But it's an interesting one at the moment. So we're going to have to see how that one plays out. We've got a last round robin game this week, and then the divisions do change. So I'm sure we'll have plenty more to say about it next week. On next week, of course, it is King's birthday weekend this weekend. So public holiday Monday, we'll be recording Tuesday. So keep an ear out for that one. But you will hear before us or from us before then with the Wednesday release. So keep an ear out for that one as well. That's pretty much us for the weekend, for the day, Kelvin. Anything else on your mind? Personal, professional? What's going on?
Nope, that's it. Always plenty to watch, and obviously, we've chatted about the big thing coming out this week, Wednesday, 2:00. We'll see what they say.
That's all on, mate. Looking forward to it. All right, mate. Well, thanks for your thoughts. We'll look forward to catching up again on Wednesday. Just want to say thanks very much for listening. Please do get in touch with any questions or feedback, maybe in advance of the MPS. If you're looking out for anything or you want us to keep an eye on anything, let us know in advance of that. We can cover that off on Wednesday. But that'll do us for today. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.